And now, it's Boomer Life. Lifestyle discussion designed to make your life more engaging, meaningful, and complete. Celebrating the baby boomer generation, this is Boomer Life on CIL 650.
The best things in life are free, but you can keep them for the birds and bees.
Welcome to Boomer Life on CIL 650. I'm George Gordon. Are you where you want to be financially? A well-thought-out plan for your financial future is a critical part of building the life that you want for yourself and your family. On Boomer Life today, we're talking about your financial future with Jim Doyle, the senior financial consultant with Investors Group Financial Services, Inc. We'll explore how accessing retirement resources can be a lot more taxing than many of us might have believed or planned for. We'll also be hearing from your associate, Paige Brettle. Paige is going to bring her planning perspectives as she comes into this industry and is making her mark. The irony for many disciplined savers who spend a lifetime fortifying the nest egg is a fear that they'll run out of money before their retirement ends. And you can kind of figure out what retirement ends means. Longer lifespans are a reality, and you have to plan for it. You may need to take a critical look at how you construct those investment portfolios. The good news is today, we're going to go talk about the good side of risk. You can worry less if you plan more. And that's what Jim Doyle is here to help us with today. Welcome, Jim.
Welcome. Risk is a four-letter word. It's not by accident.
Is it fair to say that most clients see risk as being bad because they only consider the downside of it? The chance an investment will lose money in the short term?
There is a good side to risk. And let's call this the upside of risk, the potential for higher returns over time. I believe that investors might be more inclined to assume risk and post positive returns over the long term if they have a better understanding of risk.
Yeah, you have to do a lot of research on that, and you need the right people that are going to help you get there. Risk and return are at the heart of investing, aren't they? What's a possible outcome realizing an uninspiring rate of return?
Well, I think that is a fear that people do have. Okay, we use terms like asset allocation decisions to talk about how an investment mix can be put together. And it seems simple enough to describe goals of generating an optimal rate of return that meets your objectives. But what's the outcome if you're not comfortable with risk? You fear its effects, okay? How is this likely to steer your investment decisions?
So am I hearing this, that it's important to educate clients about the risk so that they can be comfortable with it?
We say the words, but do they mean the same things to everyone?
Essential question. Give us an example of what you mean.
One of the first steps in any client engagement must take into consideration each client's level of risk tolerance. You're conservative, moderate aggressive, or aggressive. Yet, most people equate risk with volatility, and I think that's a mistake.
All right, let's then perhaps explain risk versus volatility.
Well, there's no single, a perfect way to measure risk. There are ways to assess an individual's or an investment's potential risk, okay? But before we go there, I think it's important to frame risk this way. Risk involves the possibility of permanent loss of capital, while volatility, on the other hand, refers to the ups and downs of the market or the price of an investment, share, or security.
So this measure doesn't distinguish between upside and downside variations.
A useful point to consider. A volatile stock that displays frequent sharp price fluctuations might still increase in value over the long term because the company has strong fundamentals.
So clients should not simply view a security with a noticeable amount of volatility as risky unless they need to cash out. And if we use your definition of risk again, risk involves the possibility of a permanent loss of capital.
I sat down with a client we started working with recently who's in her early 60s. She's not all that comfortable with her investment knowledge, and retirement isn't that far off for her, so she doesn't want to be making any investment mistakes. I asked if we might consider her planning in terms of a 30-year investment horizon. One of the first things we started with was to help her understand her investments, understand the risks that each of them have, and things that she could do to mitigate them.
Now, we hear this term, mitigate risk. What does it really mean?
To reduce risk. Portfolio diversification is a great way to mitigate risk, to provide downside protection. It's not uncommon for us to see portfolios that are too conservative or too concentrated, okay? Like being overweight in one category, like corporate bonds, or missing geographic diversification.
Now, I think we like to take our vacations in some of these locations, but maybe we don't like to buy our investments there.
It's no secret that international investments, they really haven't done that well over the past number of years compared to North American markets. But I think we could be making a mistake if we continue to overlook this.
How so?
Let's take a look at U.S. markets as an example. Since 2010, numbers have been pretty exciting. But if we look at the past 5-year history before then, the numbers are not so nice. It's unfortunate that a client's risk profile and what they need to accomplish in their financial plan are often at odds. That's why it pays to work with a financial planner.
A financial planner, such as yourself, you have spent a lot of time educating yourself, continuing to upgrade your skills. If you're listening to Boomer Life and you're taking some notes and wondering who you can call, we encourage you to give Jim Doyle a call and ask how he helps financially comfortable Canadians. It can be as easy as giving him a call at 604-682-5431 or send him an email at jim.doyle@investorsgroup.com. Setting financial goals and regularly reassuring where you are in terms of achieving them can require a little bit of help. And that's why you need to work with a financial planner. And how do you go about determining a client's true risk, Jim?
Your guiding principle should reflect your beliefs and how they relate to your objectives.
So some very formidable investors have talked about what their goals are. You mentioned some names.
Well, I know George Soros has been described as a seat-of-your-pants approach to investing. Warren Buffett adheres to a buy-and-hold principle, and Benjamin Graham bases his decisions on a stock's intrinsic value.
Wow. So names that we've heard of, names of people who have been very, very, very successful, and you want to say, boy, I want to be successful like them. But they are different. Different as night and day if you consider the Oracle of Omaha and what he's done. He sells nothing, virtually. He hangs on to everything and he grows it. So he understands long-term risk, and he doesn't get flustered by volatility because he's done his homework, which you obviously have to do when you're talking to people.
I think what's awesome here is that each holds their own perspective. But what is important here is that despite their differences in their styles, they succeed by sticking to their own philosophy. Okay? And the real cream of this discussion is, using your plan and sticking to your plan as well.
So we might consider an investment philosophy as a guiding framework that informs your decision-making process. Why is it important for listeners to pay attention to all this stuff?
It's not uncommon when we sit down with a prospective client for portfolio review and we look at their portfolios. We often see a problem that lingers in many client accounts. They're messy and they've got scattered investments.
So aside from performance, I'm assuming it can be difficult for the average investor to gauge whether they have a good portfolio or not.
I know when I'm looking at a well-designed portfolio. The role of each investment or portfolio segment is obvious. Now, it might be that the portfolios that have landed on my desk were problem portfolios to start with, and maybe that's why we're looking at them. I doubt it's really representative of how most advisors build portfolios.
Do you have an example or two that you could share with us?
Well, let's look at, say, balanced funds or ETFs for a moment. If the underlying investments are almost the same, and the only difference is the name of the firm offering the investment, have we achieved any real diversification? Having a fund that might be overweight in financials another that has more in consumer discretionary, and or maybe a third that has more or less energy or resource exposure. These are examples of diversification.
Now, you've talked about clients' risk tolerance and their investment philosophy. What's yours?
I might like to preface this a little bit. Okay, my risk tolerance is seasoned by 27 years of doing this daily. I watch the markets, I read a lot of industry perspectives, and invested a great deal of time into my education. As for my own investments and my personal investment risk tolerance, I'm probably a little bit more than moderate.
Okay, I used to be called chicken, and then I used to be called bull, and somewhere in between I had to find that balance, because when my trusted advisor started asking me questions about really, where do you expect to be and how do you think you're going to get there, I discovered that you, just as you were telling me, you've got to balance things out. I think that most of us would like that kind of experience in our back pocket when it comes to making the investment choices that we need to.
In my own situation, I believe I can afford the volatility, and I'm still a few years away from relying on my investments to provide me with a steady, tax-efficient, reliable stream of income. My greatest long-term fear is inflation eroding my future retirement lifestyle. I might have 30 or 40 years ahead of me. I don't want to arrive at the end of my journey and wish I'd done things differently.
Do you feel your personal investment philosophy influences how you advise your clients and the clients that you take on?
Absolutely it does. But I also need to be aware of how and in what ways it might influence my recommendations. And I think it's a great question to ask of an advisor you work with. How do you invest? Okay? How do you choose the investments that we talk about?
I think we can talk a little bit more about this coming up in our next segment, because I think it's very important. We've hit into a very important part of this, is the questions that you need to ask the people that you're talking to who are going to be entrusted with your money. So let's just stop it down here just for a second, and we'll be back to talk more about how you can do a great service for yourself in spending some time and finding the right people like Jim Doyle and Paige Brettle to help you with your investment. To learn more about Jim and how he helps financially comfortable Canadians rediscover a sense of confidence and purpose, don't forget the goal, good living. It can be as easy as giving him a call at 604-681-5431 or send him an email at jimdoyle@investorsgroup.com. This is George Gordon, and this is Boomer Life on CIL 650.
Celebrating the baby boomer lifestyle. This is Boomer Life on CIL 650.